Tim, I really hope it's getting worse. I do hope it's getting worse.
Well, it's a little tougher when you're drinking because your tongue gets in the way when you talk, when you drink.
One of my favorite things I was reading about the Australian accent and like where the origin of like where that and one of the big things they say is that specifically what it is that initially when people were settling Australia were drinking quite heavily because there wasn't a whole lot to do. And so
wow, in Australia?
But they got to a point where they're like, okay, so wait, so the accent comes from everyone being drunk? And it was like, initially, yes. And it's like, well, what happened?
What?
Well, why did that stay? And it's like, well, the people who showed up heard that and went, I guess that's how we talk here. So it's like a drunk accent that stayed until people were sober.
So their tongue was just constantly always in the way.
And there's an intro that'll really piss him off.
Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, two bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy.
Hi guys, and welcome back to Drunkenomics, the drinking podcast with the economics problem post-June Fed meeting. Yeah. And I am your gracious now and perhaps for the whole year host.
Yeah, you get the podium.
James Goldwater. And across the board from me, utterly without
no grace whatsoever.
Possibly for the rest of the year.
You know what? I'll even just plant the flag and say, you know what? For the rest of 2023 as well, I have no grace. And that makes me Aaron Wong. Okay? Nice talking with you guys. Here's the economics problem.
Just one?
Problems. Economics problems. Did I say problem? Yeah, there's too many. I just kind of make it one cocktail. So that way it's just a singular thing.
Everyone's done Hunch Punch.
Exactly.
Everyone's had a Long Island.
So you can have a Rusty Nail, which is one drink, or you can have Scotch and Drambuie, which is two drinks, right? So it's a cocktail of economics problems, right? So yeah, all those, we like to talk about them on our social media, which is at Drunkenomical, DRUNKNOMICAL.
That's on Twitter, Metaverse,
Instagram,
Facebook, and Instagram.
Which now has a new ticker symbol, but that's not the main thing that we're here to talk about. Because if you also want to get some things off your chest, we have that Discord thing that you can find on our social media pages. Mm-hmm. You can find that Discord
invitation
thing.
It's free to all.
If you have anything to get off your chest, just let us know.
Jump in, throw some questions our way.
Yeah. Let's talk about some not financial advice.
Absolutely.
In other words, if I tell you that I bought some SPY puts, that basically means that we've reached bottom, because congrats to everybody that's on the other side of my trades.
Except that this time I think you're in the right, because there's no way we're near the bottom. But that way, there's no way we're at the bottom.
But we could have dead cat bounce. So,
I guess, absolutely. I think crypto's in the middle of that bounce right now.
Well, but that was after the carnage that they went through this weekend. I mean, that was just like a hangover and a half.
I still see a hell of a lot of downside on crypto.
You know what crypto reminds me of right now? It's like if you go to a wine tasting, how there's that bucket that you spit in? This is a really disgusting analogy. So crypto took that bucket that everybody spit in at the wine tastings, and they got drunk off of that, and now they're hungover off of that. I feel like that's what's happening.
Because right now, as I look at it, crypto, what is it? Bitcoin's trading at 20,375. Ethereum's at 1,100.
What did you text me? It was like, I forget how far down they were or how much market cap that.
They were down at 17.8.
Bitcoin.
They were down at 17.8.
Well, that's just Bitcoin, right?
It's just Bitcoin.
So, so all you crypto wallet holders, first of all, I'm sorry for your loss.
And just remember, it's not. Here's the real thing, though, guys. In the same way that you hadn't made any money until you sold for a profit, you haven't lost any money until you've sold for a loss. Right now, all you've got is an unrealized loss.
Which I know doesn't make anything feel any better.
Nope.
If this is also comforting, I've made some bad trades as well. But I will say this, as part of the not financial advice, I did buy a SPY put last week. You're going to love this one. Yeah, I'm not bragging, I'm just saying. But I bought a SPY 369 put last week. I bought it earlier in the week to play on the Fed thing. Mm-hmm. So I bought the put for like $3. And then like later on that day, I looked at the contract and I was like, oh my God, it's doing really well today. And then I looked at the 368 put, which is one underneath it. And I sold that put for more than I bought the 369 put for. So I just got normally what is a debit spread? I got a credit on that. So I'm like, dude, I'm getting paid for this.
Right.
It's getting paid $115 to gamble with $100. So it's like, okay, cool, perfect. What a good trade. But not bragging, just saying.
Yeah.
But I love options and spreads.
As long as you're on the right side of it.
Yeah, I mean, this essentially, if you do options, the thing that you're betting on needs to do what you want it to do. So whether it stay the same, go up or go down,
stay inside your bracket, whatever it is.
It still needs to do that. But at the end of the day,
other than that,
you can leg in, leg out, right? There's multiple ways you can play options, which I love. But not financial advice. But Bitcoin, sorry.
I understand that this is hurting real people, not just like this fictional villain I have in my head.
The Michael Saylors of this world.
It's one of those things. But no. So we end up with that. We end up with, on top of that, we talked about Celsius, how they,
that's right.
They locked all the money in.
I feel like that's gotta be.
They locked all the money inside.
I know, but that's gotta be.
Because they hired lawyers, didn't they?
They
to restructure all their finance options and to try and survive this.
Yeah, so,
I don't know that you can.
Yeah, but how would you restructure it? Like, what would you? And
the thing is, what's backing your restructuring?
Yeah. Oh, you're a genius. It's all that stuff, that they loaned out on margin, or not on margin, but to short. I don't know trading rules around crypto because I don't work in that industry at all.
Here's the thing: there really aren't any.
Yeah, so like you can because I feel like it's like foreign exchange where like you can short other currencies, but it's
same
kind of
thing.
like that.
You just sell something before you buy it.
Oh, okay. So I think that's what they were doing was enough people brought the crypto over to Celsius from Coinbase or wherever else it was, or Robinhood, and then which speaking of which, Robinhood hit an all-time low, but they brought all that crypto over to Celsius. Celsius was now like, I don't know because you can't do it without their permission, or at least you can't do it without like having some sort of margin agreement signed or something.
Yeah,
you
have to opt in.
Yeah, but like if you have a margin account, you can't opt out. But basically, I think they were just taking crypto from other people's accounts and then they were just lending that out to other people to short. I think that's what they were doing. And now I think they're using that because I think they're technically custodians of that.
Yeah,
crypto.
but
they're using that to restructure their debt.
If crypto stays volatile, if crypto keeps crashing, then it's not really securing anything, is it?
Well, it's securing. I think
Celsius
is securing at a very high rate, or it's secured at a very high rate.
Yeah, which is not logical or good in the long run.
Well, so let me ask you something. Like, okay, so how much do you think crypto, or at least the reaction and the fluctuation in crypto prices that we're seeing recently, this drastic decline, how much of it do you think has to do with just the fact that the market, the economy is not looking good, consumer is not looking good, the job market is weakening, inflation, all that kind of stuff? How much do you think it has to do with that?
I think you have some people who bought in at I think the issue is you have people who bought in at a high, 60,000.
Or even 50,000 or 45,000 or 40,000.
Yeah,
you lost half your money that you put in.
You see 50 to 67% of what you may have put in disappear as of today. Maybe less, maybe less. Maybe you bought it at 22,000 on the way down. Who knows? But I think you've got a lot of people who bought in when it was going up and it was fine until it stopped going up. And then you had these same people rushing for the door. Because they need their cash back, and it might be they might need their cash back because the cost of living is going up because inflation is so high. And people who are just like, wow, in order to do the things that I historically do, I need
or their unemployment went out, or
maybe at some point they noticed that
right?
I got this awesome 7% raise, but 8% inflation. Wait, what do you mean I lost buying power?
Yeah, or hey, my rent, which I know this is happening to a lot of people across the country. Okay, my rent went from $1,100 a month to $1,600 a month, just like that.
Yep.
And
so people need their cash. It turns out
you can't pay rent in Bitcoin.
Places that
you cannot.
Exactly. Yeah, you need their cash because it turns out that this cryptocurrency isn't currency. I'm pretty sure we did an episode on that.
Yeah. What is money, right? Like
crypto isn't.
Yeah. Not yet. Should I even say yet?
No.
I don't know, right?
I mean,
but
not ever, really.
And while we're in this subject, I mean, did you see? So there's an NFT thing in New York today. It happened today on Market Observation Day for Juneteenth, which happy Juneteenth, by the way. I'm glad it's finally a holiday, but different subject.
Fair.
NFTs, that whole thing. Did you see that, the parade or whatever it was?
No, but
it's like an NFT.
Here's all I'm going to say is if there was an actual parade of NFTs, that defeats the purpose of NFTs.
I know. If it's a physical parade, it just doesn't make any sense. But the thing is, I saw on Twitter a bunch of pictures of protesters out in front going like, NFTs are a scam, NFTs are a scam. And I'm like, hey, hello. We've been saying that for the longest time. Just saying.
Well, yes, we have. Have you been listening?
I didn't trade any
Tell
NFTs.
all your friends. Tell all your friends.
I feel like I've warned everybody, but no one was listening. So I don't know.
Maybe. I know I've warned people. Anytime, and at this point, when these same people that I know I've warned bring it up, I know that all they're doing is trying to wind me up. Well, but kind of like I try to wind up Tim with my atrocious accent.
Well, but this is the thing: is like we warn people about SPACs, we've warned people about NFTs, because like when they first became a thing, I was like, why in God's name did someone pay $69 million or whatever it was for one NFT. And I'll admit, like the craftsmanship for that NFT was great, but $69 million? What's happening?
I agree.
So,
like it's
yeah.
with the rise of digitized frames, you can make it
Yeah.
visible in the real world. But it's still. But
Yeah.
I agree. It's still, to me, it's
Well, and I'll say this too.
it
Like,
seems-
if we were around in 2018 or 2016 or whatever, remember the pot stocks craze?
Oh yeah.
If we were around then, I guarantee you we would have said something about that. We would have been like, okay, hold on, guys, this is not sustainable. None of these companies are profitable.
They don't have positive cash flows.
They're
They're
not
not sustainable. They can't bank on a federal level.
Yeah.
They can't, like, there's so many things you have to look at. Like,
Yeah.
there are issues.
Forex risk.
But Forex risks are huge, and then
which is
but
what
that's-
Microsoft
but
cited a
that's-
couple weeks ago. But yeah,
Yeah, but to be fair, that's all just
that's a craze. I mean,
it's mania.
Yeah, the
It's
pot
just
stock
mania.
was kind of like the meme. AMC, the GameStop. Like it's the same
Mhm.
thing. And we warned about GameStop too. We're like, this is not sustainable.
Oh yeah.
I
No, for
warned
me,
you.
there were definitely points. There were points during that GameStop during the run up where I was like, man, I should really short this right now.
But you couldn't.
There were points.
But you couldn't.
I couldn't do it.
Well, you couldn't
because
do it literally because like you couldn't find the shares to short.
Well, yeah.
like the company was
yeah, you couldn't providence them because
the volumes are massive.
the firms that were shorting them, they hadn't providenced them either.
Yeah, well, it turns out that when a company with 100 million outstanding shares and it trades 400 million shares in a day, that's just not normal. That's not supposed to happen.
No.
Like you're not. It's not supposed to exchange hands 4 times in one day. The entire company is not supposed to do that.
No.
But yeah, speaking of,
and from there we get to the Fed meeting.
Yeah.
Then we
How
got.
do we get here? In so many ways, I mean that. I'm asking that question.
I think I just wanted to get crypto out of the way.
I know.
Like it's done. No, we don't have to talk about that again for next
but-
week or until something else stupid.
I know,
happens.
but I mean, stupid things are happening all the time, such as this FOMC. It wasn't just like it was like the 75 basis points. I don't mind it. Like I felt like everybody. I mean, if you watch CNBC, all the panels, like, okay, if the Fed wants to get their credibility back in a hurry, 100 basis points, let's go.
Yeah,
shoot it.
Even I was like 100 basis points. I was like,
Well,
I think what did I say last week? I said 70. I said 75 basis points is what they're going to have to do. 100 would be them really tightening the screws and reacting. But even then, both of those are still too small because we still have a negative real rate.
Exactly. But it's also like if they did 100 basis points, I feel like it's, I think it could be viewed as desperation because they know that they're losing credibility.
Yes.
They're trying to get ahead of them losing credibility, which is really ironic because last Fed meeting they said, okay, 75 basis points is out of the question, which
that was, and here's the thing for me, that was one of the dumbest things to have been said.
I totally agree.
At the May meeting, they've ruled out 75 basis points. Why would you say that?
Yeah.
Why would you say
Because
that?
you know that at some point you might have to walk that back. So if you don't want to seem like an idiot now, then don't say things like that. They're going to make you.
The great thing is, if you don't want to have to walk something back, just don't put yourself in that corner in the
Exactly.
first place.
Wow, dude, you are so smart. That is insane.
If you don't want to have to undo, oh yeah, I said that thing.
Well,
why? Because at the time I thought it was true, but now
if you don't want to unsay something, or if you don't
have to unsay something, just don't say something.
If
you don't want to have to walk back from somewhere, don't walk there in the first place.
Yeah, exactly. Just shut up.
It's
and
that
don't
easy.
do that. It's So okay, what exactly happened? Okay, first of all, I want to comment on this. Okay, so. In case you guys don't know, there is not a meeting in August.
There's gonna be a meeting in August,
but there isn't one planned.
They haven't announced it yet, but there's gonna be.
If
there's
they
gonna have
do
to be.
one in August, it will be because of an emergency meeting. But it's July, and then right now on schedule, it's July and then September. Okay, so my big problem right now is there's going to be 2 big inflation prints. How is inflation going to look in the month of June? We'll find that out in July. How is inflation going to look in the month of July? We'll find that out in August.
And then, of course, and I'll be honest, I don't think that the 75 basis point raise that happens in July is going to undo any of that. It's still going to be there. It's still going to be.
Well, and this is the thing. So the funny thing was, and I talked about this last week, was we thought that inflation had peaked in May or in April because the May report that reported April's numbers was
stayed
down.
the same.
Well, no, it was down. It was down.
Yeah.
It was down a little bit.
Slightly,
It went from like 8.4 to 8.3, I think. And then this most recent one that that showed May's numbers, it went back up. So that's what they ended up reversing. That's why I ended up walking
they
back.
reacted.
Yeah, that's why they ended up walking back. Whatever they said in the May meeting. So now they have this reaction. First of all, they're saying a 50 basis point rate hike in July, which, okay, what happens if inflation doesn't peak again, right? Like, what happens if the report comes out 8.7?
Well, then that's the thing is then you have to conclude, okay, 75 basis points is not enough. was not enough last time. So you're going to have, at that point, you have to go to 100 basis points.
And
because with rates, you do have to get ahead of inflation if that's how you're going to curb it. Now, I think there are some problems with the Fed's thinking.
Yeah,
I do think the Fed is sitting here saying,
an ocean of problems.
Well, okay, yes, but the Fed's, there's this argument that I'm hearing from a few too many educated places around the Fed federal figures saying, it's increased wages are driving this inflation. Except the problem is wage. Well, yeah, that's what some people are saying.
I know. I'm saying that's what's driving it up.
That's what you're claiming. Yeah. The funny thing is, the wage increases have lagged behind inflation. So 5% wage increase cannot drive 8% inflation.
It doesn't make any sense. It's
not possible.
Yeah.
So this argument that it's wages are causing this is nonsense. It may be part of it, but it isn't all of it. And that means that you have to look at other issues.
But the really scary thing is so consumer confidence is super low. The credit card debt right now is just absurdly high.
Oh yeah, this
personal savings rate down.
Consumer sentiment has returned to where it was pre-COVID.
I think lower actually. I think it's like pre-2008.
Well, what I mean is it's gone negative.
Yeah, again. I think. Oh, okay, yeah. I think it went down to below like 2008
Here's the thing.
Or something like that.
Yeah, the problem is in 2008 the personal savings rate was pretty abysmal.
Of course it was, but people at the time also felt strongly about the economy right before the whole thing.
They did. Now
consumer confidence is low. So you would think that with how low consumer confidence is, it would kind of drive people towards saving a little bit of money,
saving more,
saving for that rainy day.
Except they can't.
They can't because inflation is so high, and then they're still paying.
So it sets you up for a very serious problem of what happens when the money runs out.
Yeah, I know. Seriously,
that's the real problem. Is when when the credit card is maxed out.
So now you can't actually buy anything. Well, I think
because
maybe is that what does it have to take that for inflation to peak? Because that's
it's a real problem because at that point you actually have a liquidity crisis.
Yeah,
that's when that's what the real problem exists. Because the real if you think the problem in 2008 was there was a liquidity crisis between banks not wanting to loan money out to anyone, and then
but that's because they maxed out their leverage.
But it's because they brought it on themselves. They said, I don't care where this mortgage comes from. I don't care if it's true or not. I need more to package into my securities. Just get me the mortgages so I can do this. I can sell it, and I can sell it to schmucks. So I can sell it to schmucks and make money. That's all the banks cared about at the time. Now the problem will be is what happens when people don't have money?
Yeah,
because the Great Depression.
Now you have no one left to sell it to.
Exactly, 70% of your economy can't afford to buy your product anymore.
That greater fool analogy. There needs to be a greater fool. Yeah. And the greater fool needs to have money. So if the greater fool has no money,
then he's useless to you.
Exactly.
He's not.
What are you gonna do?
He's not a greater fool. He's just a fool. And and that's exactly right. That's the issue. One of the best lines.
He's a fool with no money.
I've ever heard, and I've read some of the things supporting the statement, but it was that in the Great Depression, it wasn't actually the stock market crash started it, but that wasn't the real. That isn't what really caused the economic depression. No. The economic depression was caused when there was no credit available to people who could afford it,
and nobody was working, or not nobody was working. I mean, the unemployment rate was 18% at one point, or that, which is insanely high. But when you have that much of your workforce participation not working,
it got to. In 29, it went from 3.3% to 9% to 15, 23, 24, 21, 19, 17, 15, 19, 17.
That is really bad. Okay, 19. So I guess it's much worse than I thought it was. But I mean, that's a huge. But
still,
for the most part, that's okay. So 1 out of every.
At its worst, it was about 1 in 4. At best, it was about 1 in 5.
1 in 5, 1 in 6. Right. So between 1 in 4 and 1 in 6 people were not working of your entire work.
It's disastrous.
I mean, you could see what that does to an economy. So at some point, employers were like, okay, everybody wants to work, so who's willing to work for less than the other guy?
Yep, and it becomes it's a race to the bottom. Yeah. And then somehow, during that race to the bottom, everyone wonders why it's dragging on so long, why growth isn't as good as it's supposed to be. And the answer is, well, your employee can't afford anything, so he keeps trying to get a new job, so you're rotating in new employees all the time. And you have to train these new employees, and that costs you money and efficiency.
Right.
So pay more, retain people, and stabilize your local economy.
But this is a complete different situation than 1929 because, interest rates, okay, what's it at now? 1.75% now? 150, 175, or is it 175 to 2%?
It's 175 to 2.
Oh, okay. It's still very low. I mean, I can't believe like people are freaking out about this. And Kathy Wood came out and said interest rates have quintupled. Interest rates have gone up more than 8 times they originally were. And it's like, okay, 8 times from 25 basis points.
That's
really?
yeah.
That's what you're complaining about.
Okay, 8 times. When someone looks at me and they say like, "Oh, it's going to cost it's blank percent," my response is, "Okay, is this 2% of 100 or is this 2% of 100 million?" Because one of those numbers is manageable, and the other, like as a percentage, we look at these and we go, "Okay, is that outside of a variance level?" And we accept that. But when someone's like, "Oh, it's going to cost,"
someone
you,
says interest rates have gone up, 800%. It's like so they've gone up a total of what is it at now? Like 150,
like 150
basis points. So it's gone up 150 basis points.
That's what I saw.
Wow, big deal, dude. Like, I don't know. Was Kathy would try to sound smart and try to blow my mind by saying that?
Maybe.
I don't know.
I don't know.
It didn't work.
I see that. And when it comes to the Fed, and and you said, are they trying to salvage their credibility or have their credibility? And the next thing, and as we were saying, like if you don't want to have to walk things back, don't say things that you then have to walk back. Right? Don't walk there in the first place. You don't have to walk back.
That goes into what they're forecasting, which is really what I want to talk about. Because their forecasts, to me, just don't seem manageable at all. Nothing makes any sense.
But the Fed sit out here and they said, "Oh, we plan to cut rates back down in 2024." Am I
what?
Why?
Yeah, why?
One, it's a year and a half away. Literally, the first part of that year is a year and a half away. And two,
we're literally halfway through 2022 right now. So that's we're 18 months away. Yeah.
Let's get to November 23 before we start worrying about what the economic outlook for 2024 looks like.
Why were you
maybe not wait till then, but why are you broadcasting here saying we're going to cut rates in 2024? Why? If the economy is doing absolutely great in 2020, what is the incentive to cut rates?
And what I want to know too, because I think what they're trying to do is they're trying to make sure that the markets don't absolutely tank overnight, which they also say that we don't really care about markets. I mean, Janet Yellen has said that.
Well, they shouldn't. I believe she does not.
I believe she doesn't.
Which is funny because she's a...
I know, because she's super dovish, but doves are extinct. She's a hawk now. Or at least compared to how she historically viewed things. She's a hawk now. But why are we thinking about cutting rates? I think the reason why they lost so much credibility is because they're too scared to upset markets. They're too scared to make markets peak, which is really ironic because every single time someone from the board speaks, the markets puke. So I'm just like, okay, if you guys are really, I mean, this is so weird, but like, if you guys are really concerned about markets, because the way you guys are acting, you're acting like you're super concerned about markets, but you guys say you're not concerned about markets, but whenever someone speaks, markets puke. So it's, I would
tell the Fed, all right, members of the Fed, the FOMC committee or market committee who are listening to me, markets will take care of themselves. Well, they will. Yeah, they are designed.
They should be at least doing it. They should be free markets,
and they should be capable of doing it themselves. And some of that means that if they're going to have these amazing ups, they're also going to have times where they're low. Yeah. Now, the thing is, if you really want the economy, you have to sacrifice the markets for the economy. The markets can be the most efficient way to get money into the hands of businesses that need it for expansion or other purposes, for economic purposes. But if you lose sight of the fact markets are supposed to be a reflection of the economy, not the driver of the economy, it is the tail. You cannot let the tail wag the dog. The markets will take care of themselves. Yeah. The economy is what will not. The economy is what needs the intervention. Markets should be free. Well, if someone wants to overpay,
the economy should be free too. But at the same time, like the economy, it seems like it's being squeezed right now. Which is, I don't know, if this is any reason for you to lose credibility in the Fed. Jay Powell in his press conference said the economy is strong enough to
handle higher interest rates.
Yeah. Exactly, which I'm like, okay, I guess they can, right?
I think the economy
is resilient enough, but that's I think the middle class is really resilient. They might not make the smartest decisions, but they can.
Well, it's getting the middle class and the lower class are getting hurt. Well, for me, what it boils down to right now is that you have to raise rates because you have to get inflation under control. Is rates the only method to do that based on their tools? Yes, probably right now it is, but. Until inflation's under control, you don't have it. Doesn't matter what you think you want to do in 2024.
Of course,
you have inflation under control. Then shut up.
Exactly.
Fix that problem. You're like a trauma surgeon sitting here like during a major bleed, like when this person is bleeding on the table in front of you, and you're dealing with it, and you're like, okay, well, the plastic surgeon will be able to fix those little cuts on her face later. That'll be fine. It's like that's really not the issue right now. This person might die. the mortician can probably fix those scars too. I'm willing to bet I know which one the family would rather talk
exactly.
to.
And I think that's just what the Fed is doing. And I think the Fed just has a complete distorted view of the actual economy, because I think what they're looking at is like, okay, so the job openings and like the amount of people that are available to fill them, I think they're starting to narrow. And I think once it reverses back to, I think that's when the Fed will start going like, okay, the economy is weak and all that.
The problem is, you obviously want to reduce unemployment because it's one of your dual mandates. But here's the thing: right now, the concern is it has to be the inflation aspect of it.
But, so I guess I kind of walk back what I said earlier when I said the Fed loses credibility by saying the economy is strong enough to handle higher interest rates, because I think they are.
Yeah, markets don't like it.
Yeah, markets don't like it. But right now,
we were talking before we started recording. Markets are drunk on this idea of earnings being at these insane levels.
Yeah, because I think
that's not going to happen.
There's all these the bullish panelists that go on CNBC and Bloomberg and Yahoo Finance, and they're all saying, okay, target S&P 4,800 end of the year. And it's like, okay, so the S&P is going to rally 1,000 points from now to the end of the year.
30%?
It's 30% almost.
I mean, is it possible? Yeah. Do I see it? No.
But the only evidence they're citing, because you said like they don't have a reason, but their reasoning is, they do have a reason, but their reason is just so outdated. And it's like, the Fed is going to change their forecast. Like, I think the Fed actually loses their credibility based on their forecast, because they're saying, okay, they expect unemployment to go above 4% as rates rise. Do you see that happening?
That one might make sense. So to me, the one rate that the Fed right now is kind of putting out there that I understand why they're putting it out, but they're ignoring a lot of stuff.
Is the target interest rate or
target GDP? They think GDP growth for the year is still going to be positive, and I think it's going to be zero.
Okay,
so close to zero as to be negative.
Okay, so they're saying target interest rate by year end 3 to 3.5%. What do you think about that?
Should probably be 4 to 4.25.
I think there's 4 meetings left, unless there's July, September.
It's 4 scheduled meetings left. I think they'll have to have an
November,
August meeting. They'll have to have an emergency meeting in August, because
what do you think?
You can't go 60 days with no rate change if
inflation shoots up,
stays. Or even does not go down.
In my opinion, there's a couple assumptions on that. On the August meeting is, one, GDP numbers come out for Q2 between July and August, right? We'll
have another GDP report by
So, but I'm saying before the July meeting, we'll have a GDP print, CPI print for June, and then of course GDP for Q2. At least the Atlanta Fed is lowering their guidance on Q2 GDP growth, but seems like pretty much the Fed across the board, they're all anticipating a 1.8% increase in GDP. I think. I don't think that's going to happen.
Yeah, because looking at
I hate to be a Debbie Downer.
U.S. economy contracted by 1.5 annualized on the first quarter of 2022. Slightly worse than the 1.4% decline that was predicted.
Wait, there wasn't a decline. I thought there wasn't a decline.
Contracted.
Well, I know it contracted, but I didn't think there was a decline forecasted in Q1. I thought Q1 there was a forecast of a positive like 1.2 or something like that.
Yeah, it was predicted, and it's what we got.
Really?
Bureau of Economic Analysis, is saying Q1 2022 down negative 1.5% growth, expected negative 1.4.
Whoa. Okay. Okay, maybe I'm looking at the wrong one, or maybe I'm not looking at the Bureau of Economic Analysis. Maybe I'm looking at a completely different one.
Fred?
Or maybe just Wall Street, because I'm seeing I'm looking at this CNBC article that says below analyst expectations of 1% gain. So I'm like, if analysts, whoever the analysts were, they were expecting a gain. I don't know if it was the Fed report or whatever it is.
No, everything I'm seeing, BA.gov.
Wow. Okay, so maybe the CNBC article is just behind or something, but I don't know. But I mean, this CNBC article came out in April, right? After
now, these are based on the advanced. Now, these numbers are based on the advanced data, the advanced estimate, and then we should have gotten the May. And these are also real GDP estimates as well, not
okay.
We should have.
So while we're on that Bureau of Economic Analysis website, so it turns out that that's a little bit more reliable than CNBC, but or at least CNBC is reporting one thing, because I think CNBC is reporting street, like Wall Street, like maybe Jamie Dimon was thinking that there's going to be a positive growth in GDP. Mm-hmm. It's not the same as BEA.
No, it's our economists think this.
The actual government economists think that. So I'm on that website now because it turns out that it's saying that the Q2 GDP results come out on June 20, not June 29th. That wouldn't make any sense. Q2 comes out in July 29th. And I think the second Fed meeting, the July Fed meeting, is right before that, at least according to federalreserve.gov.
Yeah, it should be about a week
their
before
meeting
that.
Is the 26th and the 27th. So why are you so they're having a meeting So at least we know that they're meeting after the inflation print of June.
And I'm also willing to bet I'm willing to bet they will have the GDP reports.
Yeah, they probably will, but okay, maybe they will.
But they won't
It's right
disclose
before, it's probably embargoed. But my thing is, okay, so if they raise, what if they do? What if they do raise by 100 basis points in that meeting? Is that saying they don't care what GDP comes out at? Or maybe GDP came out better than we thought and willing to slow the economy down a little bit more?
I think, again, GDP is, especially real GDP, remember, we're using basket year.
Yeah.
We're using a basket year for pricing, a constant year. So it's a deflator for some years, and it's an inflator for other years, because we're trying to figure out, okay, based on a constant price, which is to eliminate inflation, right? Eliminate the inflationary pressure and determine, hey, based on the growth, is it based on price changes or is it based on actual production? And right now, it shouldn't really shock anyone that we have less actual production for a higher price, unless we have growing nominal GDP.
But that's just because everything's more expensive,
real
right?
GDP.
Because if oil, because oil is $100 a barrel to $120 a barrel, right, and then they're still producing the same amount of oil, right? Then GDP is technically higher, but that's just really like an inflation.
But it's an inflation. It's not
metric,
really higher.
Right?
Exactly in a real sense. I'm not producing more. I'm just selling it.
Exactly. Yeah.
Which is the difference for those of you who want to difference between nominal and real GDP. Real GDP uses constant prices, and so or uses the same prices between all different years. Yep. So we'd be like, are we actually producing more of a good? Yes, we are. We're producing more product.
We have more iPhones. We have more whatever.
We have more iPhones. We have more computers. We have more barrels of oil. Whereas nominal GDP with the prices change. So like I could say, historically I might have been selling three apples for $2 each for a total of GDP of $6. And then the next year they'd go, hey, how's your GDP? Well, I get $6 again, so my GDP didn't change. But instead this time what happened is I sold 2 apples for $3.
Yeah.
But whereas if you look at that from a real perspective, it would be like, hey, what'd you do? He's like, well, I went from selling 3 apples to selling 2 apples, but I broke even. But I didn't. But what do you mean? Why aren't you producing more apples?
Yeah.
The revenue's the same. Yeah. Why aren't you selling more apples? Well, I raised prices.
To me, it's a little bit conflicting because, not that. I mean, that makes sense. The real nominal, that totally makes sense. I'm saying, why is the Fed meeting before the GDP report?
They will have the data. They will have the information. They will use it in their quanting process. They will use it while they are quantifying what they should do or what they believe they should do. But
and also this, because the Atlanta Fed, I think they're trying to jump ahead of everything. Because I think the Atlanta Fed, which I forget who it is, I think it's Bostic.
Atlanta,
I think he's been pretty vocal too, and it still annoys me. But the Atlanta Fed is saying the consumers are already saying that it's a recession, and consumers are about 70% of the economy. So they said GDP growth for Q2 is 0. Whereas everybody else is still a little bit positive.
There's a reason I don't like nominal GDP. There's a reason I prefer real GDP. But I think Atlanta might be right on this.
I think they are too. 0. But I think, I don't know, maybe this is a ploy to get the Fed more credibility, which that to me is just like, why is that even a thing?
Look, I'm
the fact that that's a concern right now.
I'm glad that we have well, first off, they're violating rule number 1 of Drunkenomics for the Fed, which is shut up in between meetings. They should shut up in between meetings.
What do you call it? Like district or whatever? They should say stuff that's not inconsistent with whatever. But God, okay, I'm just so annoyed with the Fed. But
see, I guess on the one hand, I say they need to shut up, and it's what I mean is they need to shut up about what the FOMC is going to do about rates. I think it's perfectly fine for them to sit here and say look, we're seeing some problems, some issues in this area, and we have a forecasted GDP. We've forecasted GDP for about 0%. We're not seeing shrinkage, but we're not seeing growth. But I still think it's a pretty brave position to sit here and say we don't see any growth.
Yeah, well, and this is the thing too, is what I don't like is when the Fed will come out and say, okay, the target inflation rate, or excuse me, not inflation rate, the target unemployment rate is 4% by the end of the year as rates increase. And then another, district says, oh, no. Jerome Powell is way too negative on that. No way unemployment goes that high. That'll never happen. And then
that's the kind of thing I'd like them to stop doing.
Yeah, and then they cite this evidence that suggests otherwise. And it's like, okay, you're always going to find evidence that's with economics. You're always going to find evidence that's the opposite of that, right? Okay, the labor market is really strong. There's more job openings.
Or you can even take the same
job. Yeah, there's more.
You can even take the same data and go, where they think
and misinterpret
this
it, or
will continue. They will interpret it very
yeah.
differently. I think this is a one-off event versus this will be a consistent event.
Yeah.
It's why in economics,
Exactly.
what is it? Economics is the art of explaining tomorrow why the prediction you made yesterday didn't come true today.
Yeah, exactly. But that's essentially that's what's going on right now. Like they're forecasting 4% unemployment and 3 to 3.5% target interest rate by the year end, which you and I are both going to call bogus on that.
Mhm.
Of course, they're planning on cutting rates in 2024, which why even think about that?
Yeah. If you're worried about 2024, you have skipped some steps.
You're looking way too far ahead.
Uh-huh. That's how you trip.
You're thinking
in
about
a hostile environment,
Yeah.
looking at the horizon, not at the ground.
You're thinking about checkmate
you're
when you've only moved 2 pawns, right? So it's like,
not the correct pawns.
Yeah, not the correct bonds. But one of the things I also mentioned too was they're planning on bringing down treasury issuances to offset some of the potential negative effects of QT, which I'm like, I thought QT was literally just, that's exactly what QT is not issuing new
Well, yeah,
treasuries.
it's putting the old treasuries out into the market.
Yeah, but it's also
that you historically they bought from you that you then agreed to buy from them for cash, but now you're selling them back the bonds they used to hold for the money to take the money out. Yes,
well,
so that is QT.
Yeah, but the thing is too, like it's like okay, a lot of these bonds that they have on their books are going to mature too. So when they come to maturity,
they'll have to
they're not going to
those.
Yeah, but they're not going to. I mean, but that's the plan is that they're not going to. Because like at some point it's like part of QT is okay, you're forcing municipalities or whatever it is to buy back their bonds. So that's essentially what you're doing. You're forcing all these because most of what they have is treasuries, municipal bonds, all that kind of stuff. That's mainly what they have, and then they have a bunch of mortgage-backed securities, and they're forcing these banks to buy back. Do you know how they're doing that? I don't know how they're forcing everybody to buy their stuff back.
I can't imagine that it's. I mean, there's a contract, and once the contract's signed, you have to do it. Like basically, it's just on this date this will occur. But I mean, I suppose the other thing is, if you were a major institution, would you really want the Fed to be your enemy? Would you really try to screw them over because they're your bank, and it's a bad idea?
Yeah,
but
exactly.
That's my guess. I'll dig it up. And I'll have an answer for you next week.
No, I have no idea how they force someone to buy their stuff back. But at the same time, it's another way they do it is these bonds come to maturity. You owe the Fed money.
Fed gonna get his money.
You got my money, man.
You got my money, man.
You got my money. You got
my money for fake mustaches. You don't got money. Where's the money, man?
You shot both my knees. Call it even, huh?
Gonna have my money.
That's such a that's the treasury's maturing. It's like okay, all right. Well, now these guys got to give the Fed their $1,000 back, right? And if they don't renew it, then that's because I mean, when the Fed buys bonds, it's it's not just like all 10-year bonds. It's all it's laddered out.
It's across the board. It's everything. And when Powell says they're gonna bring down treasury, which is offset. That's just we won't be issuing quite so many bonds across the board because we want to with the market knowing that we're raising interest rates. We don't want to stifle bond markets for the currently existing bonds by having people sitting here going, well, I'll wait till after the next meeting.
To me, this is still really unselling to bond markets because you're not the supply of bonds is diminishing. So I guess maybe that's what brings it to equilibrium.
Yeah, is that you're gonna restrict supply a little bit.
Yeah, not equilibrium, but you know what I mean. Like just like a level playing field, I guess, is more of kind of
more stable. More stable position.
Yeah, exactly. So it's like, okay, you're buying this bond at T6, right? When it's, it got this coupon and this is the value of the bond and it's got this yield. So it's T6 out of 10 or whatever it is. So yeah.
Exactly.
But speaking of central banks, why don't we just fly over the pond real quick? Talk about what's going on.
I feel like Jerome Powell right now is kind of like understanding where Jeb Bush was during that campaign stop where he was like, please clap. You remember that? Please clap.
Oh, yeah, that was pretty embarrassing. But I feel like, I don't know, dude, because like the ECB has been so far behind. The Bank of England, I think, is still currently behind because they raised, I mean, in case you're wondering, just a global rate hike took place last week. Yeah. ECB raised it by 25 basis points. Or not ECB, Bank of England did.
Yeah, but the first rise in 11. I know the Swiss bank raised by 50 basis points.
But that's only because they're trying to.
Well, the ECB hasn't raised rates yet, but ECB has.
Yeah, I meant the Bank of England. Yeah.
Oh yeah, Bank of England is the first time in like 11 years that they've raised rates.
But I thought they raised it 3 times this year.
I guess no, it's the 5th time in a row. So it's
Oh, it is 5 times. I'm seeing that now too.
Yeah, because they come from zero.
I got the BBC article up. Yeah, oof. Yeah, they went from 0 to 25 to 50 to 75 to 1.
Yeah, they've been stepping up.
Or 1.25.
Yeah. I guess what I was saying, it's the highest rates they've had in 15 years.
Yeah, it is.
That's what it was.
Because if you look at their interest rate graph since 2008, oof, God,
basically
that's
zero.
nasty.
It's kind of like the U.S. one.
Yeah.
And basically zero.
Yeah, exactly.
Or been very low, artificially low.
Yeah.
No, that's right. The last ECB meeting was we have a plan, and now they're having a meeting to come up with the plan. Right? This is the class
So they had a meeting that could have been sent in an email,
and then someone said, "What's the plan?" And they went, "Ah, shit."
Yeah, that's what the ECB is doing. But I think everybody's getting ahead of the ECB. Like everybody in Europe is trying to get ahead of the ECB, which is minus Turkey.
Yeah, I was gonna say there's only two central banks out there right now that I'm aware of that are really gunning for lower rates, and it's Russia and Turkey. And one of that, well, I would say it's because one of the countries is run by a man who clearly doesn't understand the economy and is a little bit insane. But
so that's President Erdogan.
But I realized
Turkey,
what I was really going to say is I realized that doesn't really narrow it down.
That's true, but like, so because they both don't really, but like, okay, so Putin, I mean, he understands inflation pretty well, obviously, because when he saw ruble do what it did, and then he jumped it up to 20, he jumped interest rates up to 20%.
Just like he put price controls on vodka about 5 or 6 years ago.
Yeah. Whereas President Erdogan is like, okay, 70% inflation or whatever it is.
74.5% inflation year over year.
Yeah. So talk about a negative real interest rate or negative real Fed funds rate. Yeah, them. And he's still calling for lower rates, which is ridiculous.
He's 73.5 year over year.
It didn't sound much better either way.
Yeah.
Both sound
One
terrible.
is slightly better than the other.
Yeah. But not by much. I mean, you're choosing eating dog shit or cat shit.
Nothing.
Like it's whatever it is,
Exactly.
But yeah, so the Swiss National Bank, that's what stuck out to me was that 50 basis point increase by the Swiss National Bank, because like we know the ECB is probably going to do 25 basis points at their next meeting whenever they decide to meet. Yeah, and I think the ECB is just like, okay, we're going to try to get ahead of that.
Well, no, the Swiss National Bank is probably sitting on the fact that
they own a ton of U.S. stocks
and a lot of U.S. stock, which is not doing so hot. But they're probably also seeing that the Swiss franc, that in a high inflation environment, a high cost, especially on energy and food environment, it does not especially in Europe, the energy one specifically does not have any. There's no short term end in sight. And to be fair, the 21st of June is the longest day of the year, right? So
that's the day. That's technically the day where not inflation, but energy prices are the most expensive. That's the day.
Well, I wouldn't say most expensive, but I would say is in the northern hemisphere, it's the day where the days stop getting longer and they start getting shorter. So now you start to head into winter. You're heading into winter, not into summer.
With you, if that's honestly one of the things that they're considering, I will give the Swiss National Bank a huge round of applause. That's very strategic.
You have to imagine they're sitting here looking at natural gas costs.
I understand that.
Energy costs. And if they're sitting here thinking,
100%,
we've got a weakening currency, we have a currency that may not be weakening, but we have a currency that's not doing as well as maybe we'd hope.
The Swiss franc, it
is weakening. So, okay, that's what they're doing. They're raising rates because they see a currency weakening and they see that's not inflationary environment. So I think that has to be what they're doing. And then Britain's doing the same thing, but Britain's in a slightly better position because they still have the ability to they can get natural gas from the United States. The problem is they can't get it from their ports to anywhere else because they don't have enough lorry drivers. Whereas Europe, if you're Germany or the rest of the ECB, or the Eurozone, you're sitting here looking at a lot of this going, we can't buy from Russia. We can't necessarily import as much as we want from the United States because we don't have the means. Oh, it's stuck at the port. It can't get off the boats fast enough. So now you're sitting here going, if you're Europe, you're going, we're going to have to raise rates because we may distinctly be looking at the point where industrial output might fall for want of electricity, for want of power.
Yeah, but my thing is, I don't necessarily think raising interest rates is going to bring down energy costs.
It's not. But it'll help them stabilize the euro so they have more buying power.
Other things, right? But I don't know. Like my thing is,
for that time,
I asked this question earlier. Like, how did we get here? Like, I don't like where we're at because I don't like that we have all these, not very credible, unreliable central banks that are in charge of controlling our economy, or not really our economy, but inflation and unemployment. Which I'm like, it's a lot of people that you're influencing right there.
Well, it's there's some articles I've written, some opinions I've seen out there, and kind of two of the big ones are U.S. markets will not, and we're, right now markets are up 300 points for the Dow futures, which I don't understand that. But there's one guy who was saying we will not have reached the bottom until the Fed stops raising rates. That's when you'll see the bottom of the markets. That I think there's some truth to that. But other ones were stop trying to fight the Fed.
Yeah, we should stop trying. I think we should. I think the Fed is actually looking out for you, but at the same time, it's like, dude, like guys have missed what's going on for the last year and a half.
Yep.
Like
Maybe.
like really
Hopefully
irrational.
they've cottoned on and they're big enough that they can actually arrest the issues here.
Hopefully they can, and
We'll see.
You know, this is I've never thought more about the gold standard than now. Like I'll be dead honest with you. I've never missed the gold standard as much as I have now. Not that the gold standard would have solved anything, or that we'd
Absolutely
be better off
not.
now.
Yeah, I was gonna say.
I don't know if we'd be better off now with the gold standard, but you know, we got a bunch of old people that are sitting in with PhDs that are sitting in a room that have a complete disconnect from the actual real economy, and they're the ones controlling it. So I don't know. Like it's just I don't like it. I do want to ask this question because someone asked this on Twitter, and I promised them an answer. It was a response to a tweet that I tweeted at Drunkenomical. If I haven't said that earlier, DRUNKNOMICL, that's us on Twitter. I think it's entertaining. But I tweeted something about the 10-year Treasury tops 345 for the first time in 11 years.
The yield's up there?
The yield, yeah, sorry, the yield, not the... If I said it's tops, I meant the yield, not the coupon, not the value of the bond, right? I meant the yield. And Sci Guy, Almighty Dolan, at Almighty Dolan?
Yeah,
Dolan?
Almighty
Dolan
yeah.
says, can you explain what this means? I know it's bad that the bonds are bad for the next 10 years, but what does this indicate for the market? Well, I mean, it's not that bonds are bad for the next 10 years. Because what CNBC is quoting when it says Treasury yields tops 345 for the first time in 11 years, or the highest in 11 years, they're really quoting the current bonds that are out there. So they're saying the current bonds are plummeting in value. The current 10-year bonds are plummeting in value.
In price. And in price that people are paying for them on the
essentially open. Price value. It's like if you own the bond and you want to sell it to the open market, you're losing value because the yield is going up. Why does the yield go up? Because the bond was trading at $900 a bond to now $845.
So you're buying all the future coupon payments and the $1,000 principal payment for that $845.
For $845 for that per bond, which means so if it's yielding 2%, whatever 2% divided by $845 is, that's the yield, right? So it doesn't take a genius to figure this out, but 2 divided by $845 is a lot higher. It's a much higher number than 2 divided by 900.
Yes.
And 2 divided by 1,000. So if the bond decreases in value, so the bonds, the par value is $1,000. If the bond is trading at $1,100, then it's trading at a premium. That means people want to buy the bond. Whatever the coupon rate is, divided by current price of the bond, which is $1,100, that means that's the current yield, right? So if the bond all of a sudden loses its value, that means the bond is now trading at $900 a share. Let's just say, for instance, drop that much, which would be a massive drop.
Mm-hmm. Your yield would skyrocket at that point.
It'd shoot up like crazy. So that's what's going on. That's what that means. What it means for the market, wow, what a loaded question. I guess the first thing that you have to think about is that a lot of equities are discounted to the 10-year yield. And I know that sounds convoluted, but basically the 10-year bond is essentially what most Wall Street analysts consider the risk-free rate.
And it's not, and it's multiple tranches of 10-year bonds. So it's not like just the 10-year bonds that were recently issued. It's 10-year bonds that might be
are 2 years away from
come to maturity in 2 years. A portion of them were just issued yesterday. A portion of them are 5 years out from that. So it's just what are all these 10 years doing? How is the 10-year as a whole being treated?
Right, exactly. So a lot of people consider that a risk-free rate because it's a government bond. Like, has the government ever defaulted on a loan? No,
not yet.
Right? Not yet. They came pretty close.
They flirted a few times, but
and all those times were coincidentally in the last couple of years and in 2008. But yeah, so they never defaulted. So basically, like, people consider the risk-free rate. If you park your money here, you're going to get your coupon and your par.
Yeah, you will get paid. This is what you will get
pretty much automatically. So if the coupon is 2%, or if the yield at the end of the day is 3.45%, people are looking at that going like, okay, it's pretty much risk-free. Like, if you hold to maturity, it's risk-free. If you don't, if you trade the bond, then it's always going to be risky if you trade the bond. And when it comes to equities, because equities are a lot riskier, there's what is called a risk premium. The risk premium is always the difference between the return on equities, the return on investment on equities versus the return on investment on just the bond.
Against that risk-free rate.
Yeah.
Right? So it's essentially, okay, how much more the risk premium, how much more are you paying to essentially
take on the risk of the equities? What's
the premium for what premium are you getting returned to you for assuming that risk?
Yeah,
now,
exactly.
So this question, I guess, so bonds are bad for the next 10 years. That isn't necessarily what that means. What it means is that, as I see it, the current value of 10-year bonds, people aren't willing to buy them. They're not willing to hold them.
Yeah.
So this is why.
But it's also if you do hold them, you're losing money. Like you better hold. Like
right now, if you're holding,
why would you?
Okay, right now, if the what's the yield on
it's
coupon rate of 10 years that's issued today?
Right.
It's 3.29. So 3.29. Well, inflation's 8.7. So 5.41. So you're losing 5.41% if inflation doesn't go anywhere.
Right.
So you're losing money on the bond. It's like the
yeah. But if you look if you're just looking at the dollar amount return, you're still returning about 3.29%, right? Just on dollar amount, right? Forget inflation, just dollar amount.
Yeah.
Like you're not getting that return on buying power. You're getting that return on money.
You see bond yields go up for multiple reasons. And it probably is not suggesting that there is belief that there will be a default on treasury bills, which if you have doubts about getting paid, you see yields tend to go through the roof because people go, I'm willing to take a huge loss to get out of this position because I don't think they're going to pay me and I can't afford to not pay.
So I'd rather sell this bond to you and you get defaulted on. And I'll sell it to you at a huge discount just to avoid getting defaulted on, right?
Yeah, I paid $900 for this. I'll sell it to you for $300 because I need cash and I can't have zero. So that's your Evergrande investor right now is sitting here going, I will do, or your bond holder from Evergrande is if you see yield on Evergrande bonds going through the roof, it's because they're like, I just need something.
Exactly.
I just need something.
I want to salvage this. Yeah.
Yeah.
So
I need to get out of this position and and get rid of my exposure. Whereas here at the Fed, I'd say that what you're seeing with these yields going down is, I don't know. I think it's indicative of economic weakness.
I think it is too.
Usually you'd see yields going down at that point. You'd see people going into bonds. But the reason they aren't right now, and it's going to boil down to this, and it's just because right now inflation is very bad, and people are going to cash or other securities that are paying out at a slightly better rate until they see a better option. They're just going to better options. Yeah. Or it's also possible that people are selling their bonds on the market, going to at discounts, going to cash, and then just buying things they need to survive. Yeah, but for all I know, everyone's building a bunker.
Yeah, I totally agree with you. But the stupid thing is like, okay, so 10-year yield is at 3.29%. Let's freak out, everybody. No, guys, everybody relax. The 10-year yield, this is still historically low. Like if you talk to someone in the early 2000s about, hey, the 10-year yield is at 3.23% right now, 3.29%, they'd be like, man, I wish I would have bought. Like, that's coupon rate for the most recent wave, the ones that mature on 5/15/2032. Coupon rate is 2.875. That's what it is.
Yeah.
Right.
So look at it this way. So in I hate these charts. Like when you go to read like Fed 10-year bond rates, it's always interesting because it's like, okay, what is is it the one being issued now or is it the one being maturing right now?
You have to look at the maturity date. Like when you look at the 10-year, like whenever you look at the 10-year chart, you got to look at the maturity date.
So the yield on a bond on a 10-year from June 2012, the 10-year bond yield on that day was 1.69%.
Yeah, but the last, if you don't look at the last 10 years, bond yields are still insanely low.
Yeah. Bond yields throughout up until 2008. Up until 2008, bond yields were consistently over 3%, over 4%.
4%. Yeah. Well, if you look at if you look at before 2000, they were consistently above 5%. Like even when it went down under 10% the first time, it was like, what is happening?
In 1990, bond yield was 8.7%, right? In the 80s, like the early 80s.
Yeah, the 80s.
81 bond yields were 15.5. Now that's because the markets were.
Let's just forget about the early 80s. Let's just throw that evidence out and pretend like it never happened.
Yeah, so from 1990 on, if you look at this, bond yields are only just now getting back to where they were in 2018.
Yeah. In 2018, like the economy was insanely strong. Like, do we remember that? Like, the economy was really strong. We should have raised interest rates. Like,
should have been raising interest rates
to do it to start the. And now that's why we're in this hole. That's why the Fed has lost credibility the last 4 years because 2018, all that was going on. So that's just me, right? Fed has lost credibility.
So what you're seeing is, as I'm looking at this chart, you're seeing it's showing recessions in gray, and every time you see a recession, you just see the yield plummet.
Exactly. So but that's the initial market reaction or the initial Fed reaction is recession, drop rates. But now,
but also people dive into bonds at that point. They start diving into bonds to cover their offside. And so they because it's a guaranteed payout. They know they can sell it later.
It is,
So they're going into bonds. They buy the bonds. Yield goes down.
It is if they hold to maturity, but that's the big if, right? And then of course, like if it's not beating inflation or if there's risk of default, get rid of it as fast as you can.
And as yield goes up.
Yeah, but it's U.S. government bond, so it's obviously
it's not going to be defaulted on until it is.
So that's the thing. That's the answer to that question. But anyways,
but speaking of yields, really, I don't know, plummeting, rising, it all depends. My yields hit about 0.08.
What kind of yield is that?
Well, I'll be honest. I'm beginning to suspect that people around me are afraid of default. So.
Yeah.
With that in mind,
is this round on you or is it not on you, right? With that in mind, if you want the round to be on James, get some merch, get some hoodies, get some dog bandanas.
You know what? How about
get some tank tops?
How about an apron? You know what tells everyone that you know how to grill and you know what you're talking about while you're grilling?
You're the boss.
An absolute apron. Have a Drunkenomics apron. They come in black, red, blue,
darker black.
They're adjustable,
and they're also in even darker black. That can be found all at Drunkenomics, DRUNKENOMICS.MYSPREADSHOP.com.
So that's Drunkenomics.com. And there, find our stuff. Look awesome. Stay classy. Yes. Also, check us out at patreon.com/Drunkenomics. If you don't want merch, if you don't want the bond, and you just want to buy the NFTs, if you just want to get on the Drunkenomics NFTs, or the Drunkenomics Drunk Token,
we would really appreciate all and every kind of support. Seriously, I know the economy's tough right now, so it would really mean a lot if you consider
help us out.
Keep
our liquor cabinet stocked, our ice frozen, at least until winter. Then we could just put our ice molds outside.
Yeah, our fruit fresh because I still don't have any oranges. Gosh, or lemons.
You're running out of citrus, my guy.
Yeah, well, I couldn't make it to the grocery store on the way home from work today, so.
Dude, I'll be honest. Here's the other thing. If you think inflation's bad, oh man. You just wait until you look at your citrus prices, my guy. They are.
I never thought I'd ever pay $1 for an orange.
I never thought I'd be paying like $1 a key lime.
Yeah, it was
in Florida.
It is. Oh yeah, in Florida of all places. But I understand it. Whatever you guys can do to help us out, I'd really greatly appreciate it. Tell your friends about us if you like us.
Even if it just involves, and this is a serious one. If you just want to give us a review, give us 5 stars. If you give us 5 stars, we're Drunkenomics. If you want to give us 1 star, we are Barstool Finance.
Yeah.
Remember that for your rating purposes. Write us a review. It really helps us out. And on that note...
with that said, hope you filled and killed. I hope you've played chestnut checkers. It only gets worse. I don't know. What else do we have to say?
You should all just plug in and watch Jay Powell on the in front of Congress this week. That should be exciting.
Yeah.
So
while you're doing that, make sure that you stay Drunkenomical, my friends.
Absolutely, my guys. Cheers.
Cheers.